Aside from death and taxation, inflation is another occurrence that can be predicted with near certainty over time. While the United States has experienced many brief periods of deflation, economic growth is generally followed by inflationary pressures. Inflation can occur when there is too much money in the economy, causing the price of products to rise.
What do we have today? Generous government spending? Check. Easy monetary policy from the Fed? Check. The Fed is at zero interest rates and pumping billions every month into the banking system. But because of the shutdowns from the pandemic, manufacturers are reporting supply disruptions. That's making it difficult to meet demand and pushing up costs and some consumer prices.
Of course, the negative effects of inflation are neutralized if a household's two main sources of wealth creation, asset and income appreciation, increase at a rate equal to or greater than inflation. However, as we've seen time and time again, this isn't always the case. Although the minimum wage has risen, the total cost of goods has risen faster than average wages in recent years. Are you worried about the dangers of inflation? Do you want to protect yourself from rising inflation? We'll go over each and everything you need to know about the rising inflation and different ways to protect your money from it. Inflation is approaching a decade low and far below the 2% goal set by the Federal Reserve. The normal drivers of inflation, such as tight labor markets and public expectations of higher prices, are clearly absent. Yet, after President Biden announced plans for massive new fiscal stimulus, concern about inflation had reached a fever pitch among economists as well as in markets, with long-term interest rates creeping higher. A collision of powers lies behind this separation. Inflation is expected to remain low in the near term due to enough spare capacity and decades of habits. The Fed would like inflation to marginally overshoot 2% after years of undershooting. It hopes that this would put an end to the decade-long specter of deflation as well as inactivity that has plagued advanced economies. However, some analysts and investors believe that the longer-term political environment would be more receptive to inflation rising well above 2%. They claim that the Fed's pursuit of over negative 2% inflation, President Biden's $1.9 trillion stimulus package, and new priorities such as closing racial economic gaps limit policymakers' attention to inflation. Inflation is sometimes referred to as the worst tax because most people are unaware of its consequences. To put it another way, earning 4% in a savings account when inflation is at 7% makes many people feel 4% wealthier. In reality, they are 3% worse off. As a result, it's important for both households and investors to consider the causes and consequences of inflation, as well as how to prepare so that their assets retain their buying power. Here are 3 investment strategies that everyone should consider to shield their hard-earned money from inflation's ravages. Despite the general lack of trust in stocks, owning some can be a very effective way to fight inflation. Consider your home as a company. If a corporation is unable to suitably invest its funds in terms that generate a profit beyond its expenses, it can give in to inflation. The fundamental principle of business performance is that businesses can market their products at higher prices, resulting in higher sales, profits, and eventually stock prices. Companies that can raise their prices gradually during inflationary periods are among the best stocks to buy during inflationary periods. One example is commodity resource companies. During times of inflation, commodities such as oil, wheat, and metals have purchasing power, in contrast to the price of a computer, which would be subject to producer and distributor price fluctuations. These products' prices appear to rise. Even so, wage rises aren't enough to keep inflation at bay. Price rises alone would not be enough to sustain stock appreciation if a company's expenses rise. As a result, grocery stores which may benefit from higher food prices may also experience higher costs of products sold. Look for businesses with the highest profit margins and, in general, the lowest cost of output, such as oil firms or healthcare companies. Finally, never underestimate the importance of dividends during inflationary times. Dividends boost a portfolio's overall return. So, here is a reminder. If you enjoyed the video so far, hit the subscribe button as it gives us a reason to bring more quality content. Let's get back to the video now. Real estate is still a safe investment when done for the right purposes. such as buying a house to live in. When a buyer's intention is to benefit from the property they just purchased, problems arise, while experienced real estate investors can uncover hidden values in assets. The average person should buy a home with the intention of staying in it for at least a few years. Real estate investments seldom produce profit in a matter of months or weeks. Instead, they demand a lengthy period of waiting for prices to rise. Unless you're paying cash for a house, you'll almost certainly put some money down or take out a loan, regarded as a mortgage, to cover the rest of the purchase price. The most popular forms of mortgages are fixed rate and adjustable rate, but the underlying concept remains the same. You pay off a small portion of the principal each month before you own a debt-free investment that should increase in value over time. If you have a fixed-rate mortgage, you'll end up paying off potential debt with less expensive currency if interest rates rise. However, even if interest rates fall, you'll still be liable for the fixed sum. In order to decide the best mortgage option, you must consider a number of factors. Home prices, like land prices, appear to rise in value on a yearly basis. True, real estate bubbles are normally accompanied by corrections, which may result in homes losing more than half of their value. Nonetheless, house prices appear to rise over time, counteracting inflationary impacts. Investing in yourself is by far the best way to prepare for an uncertain financial future, one that will help you make more money in the future. This investment starts with good education and continues with skill maintenance and acquiring new skills that will be required in the not-too-distant future. Staying on top of a company's evolving needs will help you not only inflation-proof your pay and thereby recession-proof your career. So, that's all from this video. Thank you for watching this. If you found this video informative, do like and subscribe and let us know in the comments below about your thoughts on this issue.